Hi everyone, welcome to Tuesday, and every Tuesday we take a look at the performance of the New Zealand Stock Exchange, being the main board of the NZSX 50. Before I do go across, remember that this is for educational purposes only. It's not intended to be personalised financial advice. If you are wanting that, you do need to go and have a chat to your own financial advisor. Now, I had a question come in last week and I thought I would address it here as well. And that question was saying, am I recommending that people invest into the US share market as opposed to New Zealand? We're going to address that during this presentation as well. So let's take a look at the performance for the New Zealand Stock Exchange first of all. Right, you can see here that we've had a positive week last week for the New Zealand main board, which is really encouraging. The volume was down from the week previous, but it is good to see that we have had another positive week. So we do want to see that continuing before we're obviously into some sort of, hopefully, positive run. Let's go and take a look at the 1 year chart and just see what that's telling us, simply because it brings these candles up to daily candles. Having a look for this for last week, Monday and Tuesday were down days. The thing about Tuesday is you've got that long tail, which is indicating that the buyers are out there and they're wanting to take control. So we did see Wednesday a good positive day. However, you've got that wick at the top, which indicates that the sellers are actually in control. But Thursday too was a positive day. Friday, however, let us down. But we've still had a positive week, which is a really good thing to see because we have been languishing a little bit. Now, if I just scroll back out, actually, I'll jump over to the 5 year chart. You can sort of see that we're in a little bit of a range bound at the moment. If I hold my cursor there, we've got a top of around 13,700. And if I go to the bottom down here, we've sort of got a range of about 12,800, sort of 1,100 difference, if you like, for a range. Now, whether we're going to break through that, I don't know, but we definitely do want to see it break above that sort of 13,100 level where we are at the moment, simply because if you follow the dotted line back to this period here, which was around December 2024, you can see that's where the market reached a bit of a peak. Now that could be providing us a little bit of a line of resistance at the moment, but again, only time will tell. We have to keep an eye on it. But let's go and put our moving averages on and just see what they're telling us. Again, I'll use the 30 exponential. And if I zoom in, you can see that the market, even though it was positive for last week, it's still trading below that 30-week moving average. Let's also put on the 15 period. And the market is just above that 15-week period. However, they haven't crossed to the upside. So even though I just mentioned we've sort of got that line of resistance, if you like, at about 13,200 level, we've got to break through that, but we've also got to see those moving averages cross on a weekly basis. Let's just go back to the 1 year chart and see how they're looking here. And that's a little bit more positive. The 1 year chart brings these candles up to daily candles, so they're a little bit more responsive. And you can see that that 15-day moving average has got very close to that 30-day, and it could potentially go through, especially if we have a good positive week this week. And then it will just take a little bit of time, and then it will happen on this weekly chart as well. So for me, I look at the daily chart just to see what's happening on a shorter time frame. It just reacts a little bit quicker. But when I'm doing my trades, I'm always basing them on what's happening on the yearly chart. Now, once again, because of where the market is, I'm not looking for any new positions at the moment. There were quite a few shares that I'm still holding that I was able to increase my stop losses on. They are showing signs of positivity, which is great. However, no new trades, simply because we want these moving averages to have crossed to the upside on the weekly chart. That's the 5 year. And we want the market to be trading above both of those, which it's not doing at the moment. Now, I'll just take these moving averages off. And what we're going to have a look at, I'm going to put the Smart Share ticker code up, which is NZG. Now, this is the ticker code that you would use if you are wanting to replicate the NZSX 50, exactly with the top holdings with exactly the same amount of exposure to the shares as what the main board has. So it means that you've got a lot more exposure to some of the higher performers than what you have to some of the lower valued stocks. And you'll find that there are just a handful of shares at the moment that are driving this market. Right. Now, we've got that on the yearly. Now, why I have brought this up is going back to that question that I was asked earlier. Am I recommending that people invest into the US share market as opposed to the New Zealand? I'm definitely not making recommendations one way or the other. Things that you do need to consider, though, if you are looking at investing into a market is what are your timeframes? How much are you wanting to invest? What do you want to achieve from it? What are your goals and objectives? Now, from there, you then also have to think, okay, am I wanting to use the likes of an index share, ETF, which will mirror an index? Now, I am pro these simply because it takes away that worry as to what shares am I going to invest in? Is it good? Should I be buying it? Should I be selling it? When should I sell? All of these sort of emotional questions that we tend to get. If you're investing into an iShare, whether it's in the New Zealand market, the Australian or the US, your holding into that will cover all the constituents that make up that indices. So if you're in the New Zealand market, you will be having exposure to all 50 companies in the New Zealand market. If it's the S&P 500, then it will be all of those 500 companies. Now, if you are wanting to minimize tax obligations and just keep away from that, then Smart Invest, or Smart Shares as they used to be known as, have great ETFs that give you exposure into those markets. Now, historically, the New Zealand market, certainly a number of years ago around the credit crisis, the New Zealand market was a very strong performer and had some really strong runs. However, it has not been as strong as the likes of the US or even the Australian market. So if we use a Smart Invest, like I've just brought up there, the ticker code that you can have exposure into the main board for the New Zealand Stock Exchange, being NZG. If you're wanting to go into the US market, you can do that as well. And that ticker code is USF. So let's pull that up and just take a look. So it's usf.nz because it's on the New Zealand market. So you can see here, it's been an incredibly strong performer. And in fact, last week as well, we've had another positive week for the S&P 500. Now, there is another ETF that you can go into based on the New Zealand market that will give you exposure to the US, and it's USH. Now, this one here has the currency hedged. So at the moment, under the first one that I showed you, USF, it's an unhedged position. So not only do you have the potential movement of that share market being the S&P 500, but you also have the movement of the currency. Now, in my experience of giving financial advice, there were times where you could have the market perform positively or the currency perform negatively, and one nullifies the other, or vice versa. And so that could happen as well. So that's something you do need to take into consideration. If you are hedging, which means that whatever we're buying $1 for into the US today, that same dollar would come back at that same rate in a future date. Okay, that is what hedging means. So it reduces the risk to currency. And this is where I've got up that ticker code, which is USH. And you can see as well, it's still been a very good, strong performer. Now, if you're thinking, okay, I want to compare both of these, let's go up to this comparison chart here. So we'll just leave on the USH ticker code and we will put up USF. You can see, so the one that has exposure to the US share market, S&P 500, that is not hedged, is currently outperforming the hedged one. That can happen. And these are the things that you need to think about as well. But by going through and having exposure to these with the New Zealand market, it does minimise any potential for the foreign investment tax rules, so the fifth rules. It also means these investments are pies, which it means for you that the tax rate is capped at 28%. If your tax rate, personal tax rate, is less than 28%, that's all you'll pay. because you can claim it back at the end of the financial year. However, if your tax rate is higher than that, this will be capped at 28%. Any of these Smart Invest shares will do that. They're all pies, so they're all capped. So if you look at this one, certainly the unhedged exposure to the US market is outperforming the hedged one. And that will change as well. Now let's take our comparison off. And this time I'm going to put up the New Zealand market again. So we'll go NZG. Here we are here. Now, if I go back up to my comparisons, and we can put in the ticker code for the S&P 500, which was USF, based on the Smart shares. So this is exactly how you can do your comparisons. And look at that. At this stage, over a 5-year period, the S&P unhedged position through Smart Invest has had a 91% return, positive return over the last 5 years. So these are things that you need to consider, but also remember that markets will change. Now, if I just go back, now neither of these have been going that long. So Smart Invest started with the New Zealand market in about 2020, and it looks like it could be a similar time as well for the S&P 500. Through this period here, which was October 2020 through to about January 21, you can see that the New Zealand market outperformed the S&P 500. More recently, though, it hasn't been the case. The S&P 500 has certainly been outperforming the New Zealand market. Now, like I just said before, it's not a recommendation as to choosing one over the other. You've got to look at your own goals and what is your purpose for doing this. But this is an avenue where you can do your research and evaluate or make comparisons between one potential investment versus another to see if one's performing strongly. Personally, when I use this, so I can do it obviously with individual shares. As you can see, I can use it for indices as well, or ETFs. If I'm undecided between a couple, then I will certainly use that comparison tool, which is just up here on the right-hand side, and put in the ticker code of the share that I am looking at investing in, or the ETF. And I do tend to favour the stronger performing one, simply because if something is trending, highly likely it will continue to trend. Yes, it will reach a top at some point. However, I like to go in favour of where the money's currently flowing. So in this example, I would be personally going into the US share there. Okay, so I'll just stop sharing. That's been a really good question, and I hope that's helped, and I hope this illustration has given you a little bit more insight as well. So just remember, if you do have any questions, or if there is anything you'd like to know regarding the share market, investing, that sort of thing, reach out. I'm here to help, and I'm happy to do a video on it. Now, do come back on Thursday. I'm looking at 2 shares on the Australian market. So one is ResMed and the other is Gentrack. Now, they both had been darlings of the Australian share market, and my partner was out recently, and he was certainly overhearing some good old bar talk, bar advice, barbecue advice, whatever you want to call it. So, and that's why I thought, let's take a look and let's do a review on it. So until Thursday, do take care.